Today, we're going to talk about something pretty dramatic that just happened in the renewable energy world. We're digging into the sudden, and I mean sharp, plunge of Shoals Technologies stock, ticker SHLS. This was a company that looked like it was on a one-way trip to the moon, and then it just hit a wall. I mean, just look at this. One day, you've got this promising company riding that huge green energy wave. The very next, a massive sell-off that just evaporated a huge chunk of its value seemingly overnight. A move this violent always leaves investors asking some pretty tough questions. And that's really the heart of the matter, isn't it? That's what this is all about. Are we looking at a classic case of market panic, maybe even a huge buying opportunity? Or is this a serious red flag, a warning sign about deeper problems at the company? Okay, let's dive in and try to figure this out. So, to get to the bottom of this mystery, we've got to start with the basics. Who is this company at the center of the storm? What does Shoals Technologies actually do? Well, here's the thing. They're not making those big, shiny solar panels you see everywhere. Nope. Shoals provides what's called the electrical balance of system, or EBOS. Think of it like the crucial connective tissue, all the essential wiring, the connectors, the junction boxes. Basically, they provide the plumbing that lets a giant solar farm actually work and pump electricity into the grid. And this quote right here, this perfectly captures the story that got investors so excited for so long. Shoals was seen as a classic picks and shovels play, like selling tools to miners during a gold rush. It didn't really matter which specific solar company was winning, because as long as the whole industry was booming, Shoals would be selling its gear to everyone. It was a brilliant story, and it fueled a ton of optimism. So if the story was so good, what on earth happened? What could possibly shatter that narrative so quickly? Well, the immediate trigger was the company's latest quarterly earnings report. This was the moment the music stopped. And here's where it gets kind of weird. If you just glanced at the headline numbers, you'd probably be scratching your head trying to figure out the market's reaction. I mean, revenue was actually up. They showed strong growth compared to last year, and they even had a pretty solid backlog of projects lined up. So what was the problem? And this is such a crucial lesson for anybody who invests. Wall Street doesn't just grade you on what you did, it grades you against what it thought you were going to do. It's all about expectations. And in the world of high-flying growth stocks, falling short of those expectations can be absolutely brutal. Okay, let's peel back the layers here, because this is where we find the real smoking gun in that report. These are the details that sent the big money investors running for the exits. Now, it's really important to be clear about this. The top line, the total sales number, that wasn't the main issue. The demand for their stuff was still pretty strong. No, the real killer was right here, profit. The two words that sent a shiver down Wall Street's spine were margin compression. All that means is that for every dollar's worth of product they sold, they were actually making less profit than they were before. And for a growth company, shrinking profitability is a massive, massive red flag. So you're probably asking, why would their margins shrink? Well, it can be a whole mix of things. Maybe the cost of copper and other raw materials they need went way up. Maybe global supply chains are still a mess. Or maybe new competitors are forcing them to cut prices to win deals. Whatever the exact reason, the result is the same. Their costs were growing faster than their sales. And just when you thought it couldn't get worse, then came the 1-2 punch. So not only were their current profits weaker, but management didn't exactly sound super confident that things were going to get better anytime soon. Their forward guidance, which is basically their forecast for the future, was really cautious. And if there is one thing the market absolutely hates, it's uncertainty. But look, a weak earnings report, even a bad one, doesn't always cause a stock to just crash and burn by 30%. In this case, there were accomplices. There were other factors that came together to turn a bad situation into a total meltdown. It all created this brutal downward spiral. First, that weak guidance from the company led straight to analyst downgrades. When they started cutting their price targets, the big institutional funds and all the automated trading algorithms started selling hard. At the same time, the whole solar industry was facing headwinds from higher interest rates, making it more expensive to finance big new projects. And finally, you get the market psychology. The price plunged right through some key technical levels on the charts, and that triggered a final wave of automatic stop-loss orders and just pure old-fashioned panic selling. This quote just nails it, doesn't it? This stock wasn't just priced for success, it was priced for absolute perfection. The market had baked in this story of massive growth and rock-solid profits, so when reality delivered something Less than perfect, the stock didn't just dip, it had to completely reset to a new, much lower valuation. So, where does all of this leave us now? Well, right now, the market is in the middle of a huge tug of war between two completely different stories about the future of Shoals Technologies. And this really lays out the battle perfectly. In one corner, you've got the bulls. They're saying, hey, hold on, revenue is still growing, and the long-term shift to renewables isn't going anywhere. This is a temporary cost problem, a classic market overreaction. But in the other corner, you have the bears, and they're firing back, not so fast. This margin problem could be here to stay. That amazing growth story everyone believed in, it might actually be broken. So if you want to know who's going to win this fight, these are the things everyone is going to be watching like a hawk. First and foremost, can they get their costs under control and get those margins to stabilize? What will their guidance sound like next quarter? And of course, what's going to happen with interest rates in the wider economy? The answers to these questions will tell the tale. So, to wrap it all up, this wasn't just one thing that went wrong. The SSLS crash was really a textbook example of a perfect storm. You had a company delivering disappointing results. At the exact same moment, the broader market environment turned against its entire industry. And all of this leaves us with the billion-dollar question. Look, the long-term story for renewable energy really hasn't changed, but short-term reality can be incredibly painful. Whether this crash ends up being a warning sign or a massive buying opportunity, all comes down to this one question. Can this company fix its profitability problem and get that earnings engine firing on all cylinders again? That's what we'll all be waiting to find out.